Welcome to my channel. I'm going to show you step-by-step how to value a stock. Together we will enter the company's financial information and capital structure into my Excel model. Then we determine whether the stock is a buy or sell. At the end we calculate and analyze the financial ratios. The company we're going to look at is Commercial Vehicle Group, and this company is a manufacturer of automobile and commercial machinery parts. Let's get started with the model. This company has a market cap of $130.1 million. So it's a micro cap company since its market cap is below 300 million. And they're trading at 407. You can see the stock went up 37% today. That's why I'm doing this video. So it's a penny stock. Let's get the free cash flows. And that's how you value a company. You estimate the future free cash flows and discount that back to today. And the free cash flow is cash flow from operations minus capital expenditures. We also need the net income, which is the profit and loss for the company, and that's on the income statement. And then we're going to pull the revenue, which are the sales for each year. That's also on the income statement. And you can see the sales go up a little each year, which is good. In 2017, they had negative free cash flow and negative net income, but every other year it's been positive. The government passed the Tax Cuts and Jobs Act of 2017. This was a one-time tax charge to companies, and this company had $11.2 million tax it had to pay, and this brought their net income to negative, and they also had negative free cash flow from this one-time tax expense. So we don't expect this to happen again, or at least it's not recurring. But according to the income statement, they are operating profitably. This was just a one-time thing that they couldn't really avoid. Let's look at the capital structure of the company. We want to find out the interest they pay in their debt. That's $17 million. And let's go to the balance sheet to see how much debt they have. And we'll go to liability section. And current debt of $3.3 million. That's debt due within 12 months. Long-term debt of $153 million, that's debt due after 12 months. Since interest payments are tax deductible, let's get their effective tax rate. We'll go back to the income statement. Income before tax of $21 million. And income tax of $5.8 million. So their effective tax rate is 27%. To get the cost of debt, it's the interest rate on the debt times 1 minus the effective tax rate, and that comes out to 7.9%. Now to get the cost of equity, we need the beta. The beta is how volatile a stock is relative to the market. And they have a really high beta, 3.25. So stock moves more than 3 times the market. So it's a pretty volatile and risky stock. Let's get the current assets. We need this to calculate the current ratio later. And current assets are assets that you can liquidate into cash within 12 months. And that's $255 million. And let's see what that's made up of. 39 million cash, 115 million net receivables, 83 million in inventory, and 18 million of other current assets. Let's get the current liabilities. That's also part of the current ratio. 106 million. Let's see what that is. Current debt of 3.3 million. 63 million of accounts payable. 20 million of accrued liabilities. Accrued liabilities are expenses the company incurs but hasn't yet paid those expenses. Payroll and payroll taxes are a common type of accrued liability. Deferred revenue of $524,000. This is income the company received but it has not yet delivered a product yet. Let's get their equity. That's $128 million. Equity is total assets minus total liabilities. That's the value of the company according to the balance sheet. That's $323,000 of common stock, negative $60 million of retained earnings. Retained earnings is the income that's left over after paying your dividend. So they're operating at a loss historically. That's not good. Negative $46 million of accumulated other comprehensive income. These are unrealized losses on some of its securities. Let's go back to the income statement, get their operating income. That's $40 million. That's how much it makes on their operational business before paying interest and taxes. Let's look at the capital structure. They have 55% debt, cost of debt is 7.9%, 45% equity, cost of equity is 27%, and the WACC is 16.5%. That's a blend of the cost of debt and cost of equity. and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's up here in blue. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company $200 million. We divide that by 32 million shares. We get an intrinsic stock price of $632. It's trading at $407, so it is trading at a 36% discount. So it's a buy according to the model. Let's see what Simply Wall Street says. They're saying the stock is worth only 33 cents, so it's worth almost nothing to them. That's really interesting. Let's see what the stock has been trading. It looks like it peaked around $12, $13 a few years back, but it's at a fairly low point. So it looks like it has a lot of room to grow, but it's a very risky stock. It's pretty volatile. It can move all over the place. Let's look at the financial ratios. Good PE, really good price sales, and a really good price to book. So PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 8.2. This indicates investors are willing to pay $8 for $1 of earnings. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 0.1. This indicates investors are willing to pay 10 cents for $1 of sales. It's a really good ratio. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 1.0. This indicates investors are willing to pay $1 for $1 book value. So book value per share of 403 indicates that if the company went bankrupt today, it would be able to pay its investors in full. Their current ratio is good at 2.4, a low ROE, and a good interest coverage ratio. Current ratio is current assets over current liabilities, so they can cover their current liabilities. ROE is net income over equity. I like to see above 20%, so they're a little low in this category. Interest coverage ratio is EBIT over interest expense. That's 2.4, so they can cover their interest payments. And I don't have any companies to compare them to because I haven't done any videos of anybody in the same industry as them. They are a micro-cap stock with a high beta, but if you're looking for really big price swings and hoping to get lucky, this is a stock for you. Let me know what you think in the comments. Thanks for watching.